Okay, in the interest of time, I'm going to go ahead and get started, and we might have some last minute folks roll in here, but no worries. Welcome to Learning the Lessons of Time. Thank you for joining us this afternoon. My name is Ashlyn Levitt, and I'm the Assistant Director of Events and Volunteer Management in Grand Valley's Alumni Relations Office. Throughout the whole month of February, we have invited you to join us for lunch as we dove deeper into a variety of key financial topics. Together, we have learned about financial basics, college planning, and the 6 barriers to financial success. Today, in our last session, we will focus on learning the lessons of time. Before I introduce our presenter, I do have just a couple Zoom keeping notes. This presentation will be recorded and will be accessible on the Financial Sense webpage. Please feel free to submit questions using the chat function. At the end of the program, if we have time, I will take questions before wrapping programming up right around 12:50 p.m. With that, if you have joined us for other events in this series, you may feel like you know her well by now, but for those who are just joining us for the first time today, I have the pleasure of introducing Melissa Stewart. Melissa is an '09 GVSU alum and a financial advisor. We are lucky enough to have her facilitate our program this afternoon. As the founder of Clear Vista Advisors, Melissa's main mission is to help provide people with a clear view of their financial future. Melissa strives to take complex investment concepts, retirement plan best practices, and financial planning topics and simplify them for her clients. At Clear Vista Advisors, Melissa believes in tailoring customized service approaches and solutions to help clients meet their unique situations, industries, and demographics. Melissa, thanks so much for being here this afternoon. Oh,
Let's try to unmute, right? That would help first. Thank you so much for that warm introduction. I really appreciate it. And thank you for all those that are taking the time out of your day to join us. Hopefully you have a coffee in hand if you're in West Michigan after the whiplash we just got with the weather in the last 24 hours, going from 72 degrees last night while I was out grilling burgers to 21 degrees and windy now. So hopefully you have a coffee in hand today. But we'll go ahead and get started. So I'm going to share my screen and hopefully you can see this. Can you see my screen, Ashley?
Yep.
Okay, that's great. Love that. So again, my name is Melissa Stewart. I am a financial advisor with Clear Vista Advisors. After 17 years working for some very large investment firms, I decided to open up Clear Vista Advisors about 3 years ago. So I've been in the industry now for about 20 years, went to Grand Valley State University and graduated with a double major in finance and business management. After graduation, I went on to go get my certified financial planning designation, as well as several other accreditations to help further my education and support my clients. And when I'm not running the business, I used to volunteer for the Grand Valley State Alumni Board. I rolled off that last year, and I'm currently on the board for Safe Haven Ministries locally, as well as on their finance committee. I'm also running after my 13-year-old daughter and my 11-year-old son, who are very active in sports and in their academics, as well as my fur babies. So just a little bit about me. As Ashlyn said, we will take questions at the end of today's presentation, so I encourage you to grab a pen and paper and take some notes along the way, and then save your questions for the end. I'm happy to help answer them once we make it through a lot of the information today. So I'm gonna take a moment here and put up a different presentation. So just 1 second here. I'm gonna get this one up. Share screen, swap. All right, hopefully you can see the new slide.
Good.
Can you see it?
Yes.
Great. All right, so as mentioned previously, I work with, well, at our last presentation, I work with other partners. Like last presentation was provided courtesy of JP Morgan Asset Management. Today's presentation is provided courtesy of Franklin Templeton. These are companies that provide investments, and then they work with financial advisor and provide us with really good resources for us to share with our clients and with the community to help provide additional education. So that's why you see Franklin Templeton across this presentation today, because they're one of my partners that I work with. So before we get started, I'm gonna start out with a question. What has a bigger impact on investors? Good news or bad news? To me, the answer is obvious. It's bad news. After all, people have a tendency to take good news in stride because in our heart, most of us believe we deserve to be happy. That is the natural state of things. But if you think about it, who wants to read a book where there are only good things happening? Without conflict, without drama, we tend to lose interest. But bad news is another story. It packs an emotional punch because it represents a threat to our wealth, our investments, our livelihood, when we think about ourselves and our family. And think about it, how people respond to a threat, our eyes widen, our stomachs turn, our hearts beat faster. The same sort of reaction takes place in a subtle way when we see a headline that the markets are tumbling, that the economy is doomed, etc. And the media understands that. It's their business to get your attention, and they know bad news does that. And so there's a tendency to present bad news in a dramatic way, with scary headlines and worst case scenarios. But the fact is, the market rises and falls, the financial crisis come and go, and through it all, we see the value of our investments go up and down over time. Because of that, it can be really helpful to look back at the past as a reality check. And that's exactly what we're going to do next over the next few minutes, with the help of some significant headlines over the past 5 decades. By the time we're done, I think it will be clear that no matter what the headlines say today, over the long term, we can learn from the lessons of time. The dates may change, but the headlines stay the same. Big picture concerns like market declines, economic turmoil, worries about job and financial security, retirement, and more have come and gone many times before. No wonder that even when things are looking up, investors can easily be swayed by fears about the market and the economy. Even though we know in our minds that the markets go up and down every year, it's hard not to get nervous when our investments lose value. With our minds clouded by emotions, it's easy to forget the past and conclude that this time is different. That's why in every kind of economic environment, it's important for financial professionals to be ready to put things in perspective for our clients and to help investors recognize that short-term thinking can actually get in the way of reaching your long-term financial goals. Today, we'll look at time periods in the market that made investors concerned about upcoming recessions, financial security, ethics of businesses and our government. But more importantly, at the end of the presentation, we'll talk about what you can do about it as an investor. So if we just take a quick look here, this is the Dow Jones. And you can see with the Dow Jones that over time, we've had all of these different time periods with headlines in the news, right? In 1973, oil prices skyrocket. 1982, double-digit unemployment fears in our economy. 2000, we had the tech bubble burst. So we see all these different time periods, but then down here on this blue area, this blue chart is the Dow Jones Industrial Average, which is one of the indexes we use to judge how the stock market has gone up and down over time, how your stock investments or your equity investments have gone up and down over time. And can we see the long-term trend here that why we've had these downturns, like the financial crisis in 2008, 2009, in the long run, we see that as long as you stay invested over the long run, typically you'll be rewarded. So first, let's take a look at some examples of headlines that influence investors, starting with stories about recession and market-related fears. Let's start with a decade that saw more than its share of problems, the 1970s. This was a lost decade for stocks, with 2 huge drops in the market canceling out investors' gains. So really, what we mean when we say a lost decade, it means you could have had your money invested in the market and you wouldn't really have seen a whole lot of return over this 10-year time period if you had your money invested in the stock market. The decade started in the middle of a recession, and as the government spending exploded, by 1972, citizens were losing faith in our federal government's financial integrity. So government spending exploding, that sounds familiar. We just had that more recently with COVID-19 spending from our government, right, to help sustain our economy. In 1973 saw the start of the longest recession since the Great Depression, lasting 16 months, and oil prices skyrocketed. Fast forward to 1979, oil prices were out of control, and for the second time in the decade, inflation was at double-digit levels. And we remember high inflation just recently, right? The Federal Reserve is trying to bring that back down right now. The Federal Reserve Board Chairman Paul Volcker at the time responded by dramatically raising interest rates, sound familiar, which ended up having positive long-term effects, but unfortunately hampered economic growth as well as investors' faith of the future in the short term. Looking back, it's clear that the US banking system dodged a bullet during the financial crisis. As new regulations over banking continue to be put in place, this issue still lingers on. But the stability of banks was also top of mind in the 1980s. In 1984, the banking system began to wobble thanks to sloppy lending practices and increasing competition. 78 banks failed that year. In 1987, of course, was the year of Black Monday, when the Dow Jones dropped more than 22% in a single day. It was a day that shattered the confidence of many investors and shook the country's faith in the markets. By 1999, the recession that followed Black Monday was over, but the country was still suffering from high anxiety over a host of economic problems, including a jobless recovery, the impact of the first Gulf War on the markets, and tremendous fallout from the government bailout of bankrupt savings and loan banks. And I don't know if you remember, but last year we had regional banks. Silicon Valley Regional Bank went under, and so we had some of these same concerns just recently with our banking system. But if you remember that first chart, over that time, we've still seen the market go up over time. By the 1990s, home prices were imploding at the start of the decade, and in 1992, a host of long-simmering structural problems continued to plague the American economy. But in spite of all of that, there was light at the end of the tunnel, and by 1997, the American economy had recovered much of its vitality. Until, of course, 1998, when global financial turmoil extending from Russia to Asia to Latin America spooked the American markets, which witnessed an 8% drop in the Dow over the second half of the year. Then came a time many of us remember well, the growth and subsequent collapse of the dot-com bubble, which resulted in the Dow dropping 38% between the start of 2000 and October of 2002. But perhaps the most dramatic drop in recent memory was when the US market plunged 777 points in September of 2008. Today, we have experienced massive market declines, recession fears, and most recently, the Ukraine-Russia war, the Israel-Hamas war, and upcoming presidential elections dominating headlines. Painful as these things may be, this is a reminder that they are not entirely new. I don't know, I mean, I'm just going to talk a little about 2008, 2009. As a financial advisor, that was the first recession that I had been a part of, and I was managing at an office of advisors. And I just remember people thinking that like the sky was falling. If you remember the financial crisis, we had Lehman Brothers going under, we had TARP money, we had a government bailout of other banks. So, we saw this huge decline in the market, but then over time, the market has recovered and continued to climb. Financial security. Of course, when Wall Street and the economic system suffer, Main Street suffers too. Individuals see the value of their investments shrink and worry about their personal financial security. They ask, is my job safe? How will I afford to retire? Will Social Security be there for me when I need it? Retirement, Social Security, and job opportunities are often major concerns during times of economic uncertainty. However, As we have just seen, economic uncertainty is something that comes and goes over time. Let's discuss headlines that might instill fear around financial security. As this presentation opened up, we talked about the media, and media outlets they're paid by the number of viewers they have, right? Media outlets are paid by advertisers, and the companies that want to advertise with them based on their number of viewers. So they want viewers to come back. And unfortunately, if news was good all the time, right? If you watch the news and 80% of the news was just, great news about what's going on, I don't know that we would come back to it every day, because we'd be like, oh, well, it's just, everything's great. So really, we see news showing us a lot of what's wrong in our economy or in our government or around the world. And that creates concern. There's a study out there, and I don't have it today to cite it, but I can look it up after today's presentation. But it specifically states that if you watch the news in the first part of your day, your happiness level will actually be lower than those people that don't watch the news in the morning. So, just be cautious of this, because the media definitely likes to put these headlines out there and instill fear, so that way you come back and watch the next day and the next day and the next day. With companies all size affected by the credit crisis and declining investment values, job security is a major concern on the top of many workers. In 1993, persistent job woes test the economy, and confidence erodes with 3 straight years of rising unemployment. Retirement, of course, is a very sensitive issue for many older investors who counted on retirement plan savings and investments to finance their golden years. And then they now find these holdings greatly reduced in value. These soon-to-be retirees can often ask, can I afford to retire? Especially as US healthcare costs hit $4.2 trillion in 2001. We continue and will continue to see headlines about jobs, retirement, and Social Security. And then the last topic, of course, is ethics. Of course, there's been a lot of questions around business ethics in the wake of troubles on Wall Street. We also see Washington ethics being questioned, and you have to expect that people want to know how we got here and who was responsible. One of the top cases I think of with ethics is, if you remember, like Enron. In fact, I studied that case in college, Enron collapsing, and the ethics of the company and the auditors that were auditing that company. And that's really, we really see, the government stepping in and creating new regulation to make sure things are overseen appropriately. Well, ethics has been a long-term concern, not just the ethics of specific deals like the Lockheed bribery scandal in 1976, but the ethics of businesses in general and of Wall Street in particular, and of course, our friends in Washington. Let's not forget Nixon's resignation in 1974, Lockheed's $22 million in bribes in 1976, the S&L scandal of 1993, the Enron debacle of 2001, and the most recent college admission scandal, where wealthy parents paid for their children to be accepted into well-known universities, bypassing the standard process of accepting the most qualified applicants. So we see these issues in the news as well. It doesn't just necessarily have to be about the economy or the markets or upcoming recession. We can lose faith in the system when we question the ethics of companies and our government. Over the last few minutes, we've looked at a lot of scary headlines and seen that the same issues keep coming up every few years. But fortunately, there's more to the story. The fact is that there has been an awful lot of good news over the last few decades too. And that's because Americans are amazingly resilient in the face of economic adversity. We've bounced back again and again. And the way we've done that is by accepting our losses and then going out and continuing to build our wealth. Why do we do that? Because, as the quote expresses so beautifully, Nothing we can do can change the past, but everything we do changes the future. So let's switch gears and look at good things that have happened following previous periods of economic stress. In this next section, I want to take a look at several historical times of period that show how dramatically the market bounced back from its lowest points during 4 bear markets. For those of you who are not familiar with the S&P 500, it is an index or something we call a benchmark, which tracks the performance of 500 commonly held US stocks and is a great indication of performance of the stock market. The S&P 500 would be comparable, although a little bit different, but it would be comparable to the Dow Jones Industrial Average that we were talking about earlier in the presentation. Let's take a look at my first example, which outlines the 1973-1974 bear market. A bear market occurs anytime the market drops more than 20%. So we have bear markets when we invest, and we have bull markets. We don't like bear markets, but we love bull markets. So a bear market happens anytime the stock market drops more than 20%, and the bull market happens anytime the market's up more than 20%. So during the time period peak to trough, the S&P 500 dropped 42.64%. Peak is the state of the business cycle or market cycle from the end of a time of growth period, and trough is the declining activity and the contraction of the markets when it hits an ultimate cycle bottom. So our economy goes really through time periods of expansion and hits that peak, and then it goes through periods of contraction and it hits the trough. And this is really the normal economic cycle. Like the market gets too hot, stocks might get a little overpriced, so then we see a drop. Business revenues are a little bit too high. There's this constant pendulum happening in our markets that kind of try to keep things in balance, right? If inflation's too high, the government, the Federal Reserve raises interest rates to help bring inflation down. And so there's this constant swinging going on in our market, but also in the economic cycles. So we see this time period of peak to trough. As I was saying, during the 1973-1974 bear market, the S&P 500 dropped 42.64%, but it was then followed by a year of remarkable growth, with the index raising 38.14%. After 5 years, the cumulative total return was 117, about 118%. And after 10 years, it was up cumulatively 327%. So if you attended the 6 lessons and barriers to investing presentation that I gave previously, the problem is that when we see our accounts down 42%, we feel bad about the markets, and we're like, oh my gosh, and there's bad news going on, because there's always bad news. So we're like, oh, I don't want to see my accounts go down anymore. I'm just going to get out of my investments because I don't want to see my accounts go down anymore, right? But if we had held on to those investments, we would have seen a 42% drop. But then over the next 10 years, we would have seen a 327% recovery. Okay, so that's kind of the point. Number one rule for investing is buy low, sell high. But as investors, we often do the opposite because we're scared about things. We don't want to see our value in our account go down anymore. And so we usually typically get out of the markets or get out of investing at the wrong time. And then we buy back in when we're feeling better about things. And then we kind of accepted those losses along the way. The October 19, 1987 Black Monday crash was a historic event and instilled fear in most investors. The stock market reflected this fear as the S&P 500 returned negative 29% peak to trough, top to bottom. Yet a year later, the market was back up 23.3%, and 5 years later, a cumulative total of 122%. 10 years later, it was up an astonishing 456%, erasing the losses of 1987 many times over. You seeing a theme here? And we could say this too, like when COVID hit and we saw the market drop during COVID, I thought it was going to take 2 to 3 years for the market to fully recover. And the market recovered in like 6 months when COVID hit. We saw this back in 2002. 2002, the market was down 18%, and in 2023, it recovered, fully recovered in 2023. How many people remember the dot-com bubble bust from 2000 to 2002? We experienced another bear market with the S&P 500 index down 47%, peak to trough, so top to bottom. Yet in the following year, it bounced back 36%. Now, over the next 5 years, the S&P 500 cumulative returns were 120%. In 10 years, 130%. So, I mean, those are great cumulative returns, right, over time. So, most recently, the global financial crisis, which started in 2007 and lasted through 2009, the S&P 500 dropped 55% from top to bottom. This is, this was a hard time period because during the financial crisis, we thought the sky was falling. Some people did. And I had people wondering if the whole entire system was going to collapse. And I just have to go based off of history, and it's never done it. And I think that with our Federal Reserve and our government, and with the one thing I will say is that no matter what, no matter if we're in a recession, no matter who gets elected as a president, the owners of companies come in every single day to look for ways to make their company more profitable. And, based on who's elected, maybe tax systems change. And so the company figures out, how to revamp things to take more advantage of the tax system. Maybe they put more factories overseas. Maybe they take their factories and bring them back to the US. But the owners of businesses, no matter what's going on, are still looking for ways to change their businesses to make them be profitable. And at the end of the day, the profitability of companies are what underlie the value of their stocks in the market. So when we saw this 55% drop, but once again, the year following the bottom of the market is represented by the S&P 500. It was up 72%. And after 5 years, it was up 208%. And then an astounding 400% 10 years after March 9th of 2009, when it hit its bottom. Of course, the fact this happened before is not guaranteed. It will happen. It's not guaranteed that it will happen the same way again. But it does illustrate that this scenario is not entirely unprecedented, and that over the last few decades, market turmoil has actually preceded market opportunity. Investors during periods couldn't possibly have known their investments would have grown so dramatically, making the case that if you remain fully invested, markets could recover over time. This is why it's important to seek a trusted financial professional who will help you stay committed to your investment strategy and your financial plan. Interestingly enough, when you work with a financial advisor, there's a study done by Vanguard that shows that the average advisor adds about 3% in value. It's called the Advisor's Alpha, the study. And Vanguard is one of the largest investment firms in the nation, in the world, honestly. And they value an advisor to be at about 3% in value based on helping you with your investments and the advice they give. And but interesting enough, of that 3% in value that an advisor can hopefully provide you, 1.5% comes from behavioral coaching, meaning helping you stay invested when we do have these market downturns, and helping you make the best decisions. In fact, investors who had the courage to stay in the market, even after major downturns, have ended up profiting over the long term. Consider the results that 4 hypothetical investors would have earned during the October 1987 market crash. Let's assume that each one put $10,000 into the market at its peak value that year. So, we say buy low, sell high. These investors made the mistake of putting $10,000 in when the market was at a high, so right before the crash, okay? The first investor panicked after the crash and sold all of his holdings, or her holdings, which left him with $7,800 loss. I'm sorry, let me say that again, which left him with $7,846 a loss of more than $2,000. The second investor sold all of his holdings and moved the assets into a certificate of deposit, earning a hypothetical 5% rate of return. So a certificate of deposit is an investment that you can buy usually at your bank. They have a maturity, so they're like 6 months or 1 year or 5 years. And so in this situation, the CD was going to earn this investor 5%. That left with him with about $26,859 after 20 years. The third investor decided to leave his money in the market, but did not commit additional funds, so didn't invest any more money. After 20 years, that investor would have had $72,315. The fourth investor had the faith that the markets would ultimately deliver growth, and not only kept the $10,000 investment in the market, but also continued to invest $200 each month for the next 20 years. At the end of the period, that investor would have ended up with holdings worth $225,000. Now, of course, this is a hypothetical example and real life isn't so simple, but the underlying principle that this demonstrates is very real. Investors who keep faith in the market, who make contributions through the inevitable ups and downs over the long time periods, are well positioned to reach the goals they have established for their retirement, their children's education, and for whatever needs feel they have that are important to them to help reach their financial goals. As already stated, those investors who invest consistently rather than try to time the market improve their odds of attaining their goals. In principle, timing the market is simple. You buy when your investments are at their lowest point and sell when they're at their highest point. The trouble is that it's next to impossible to consistently guess exactly when these things are happening. For this reason, many professionals advocate simply leaving your money invested for the long term and riding out the cyclical up and downs of the market. So remember when I said when we had COVID and the market dropped and then it recovered over the next 6 months, or when we had in 2022, the market being down 18%, the S&P 500 being down 18%, and then it fully recovering in 2023. These things are just nearly impossible to predict in the short term, but in the long term, we know the market has a trend of going up over time. It is clear that remaining in the market can help in reaching investment goals. Even missing a few days in the market might cause you to lose out on the biggest gains, which are often concentrated within just a few trading days. So, for those investors that are like, oh, I'm just gonna get my money out of the market right now. I'm gonna take my money out. I'm gonna put it into like a money market. I'm just gonna leave it in cash. I'm gonna sell my investments and just leave my money in cash right now. And I'll get back in when things turn around. The problem is that when they turn around and we have really good days, they happen very fast and they're usually pretty concentrated. So most investors miss those good days. As you can see in the chart, an investment in the S&P 500 index from the beginning of 2003 through the end of 2022, a 20-year span, would have returned 9.8%, excluding the effects of dividends. So that's just, I had my money in there, and then we'll go into dividends at another time, but that's just having my money in there, and these companies pay dividends, but that's not taken into account here. But missing just the best 10 days in this 20-year time period would have reduced that average annual rate of return to we'll round that up, 5.6%. If you had missed the top 100 days in this time period, your return would have been a negative 10%. Timing the market may seem rewarding in the short term, but if you miss the top trading days between the beginning of 2003 and the end of 2022, you would have dramatically decreased your returns. In closing, I'd like to sum up with 7 principles that every investor should reflect on during challenging and uncertain times. The issues that worry investors today aren't new. I think we've seen that pretty clearly in our review of historical headlines. In our modern world with TV, the paper, how many of you get a newspaper nowadays? The internet, and magazines all compete to interrupt what's happening. That's a lot of noise out there. Trying to zero in on what's really true amid the talk is never easy. In fact, when we had the Silicon Valley bank go under, Part of it was just what was going on in social media that was expediting it. So news and information is transferring so fast nowadays that we're really seeing the market react a lot faster. Um, Before I got into the industry, it used to be that investors would just get their quarterly statement. And so you didn't really know what the value of your investments were doing on a day-to-day basis because you just got your quarterly statement. Now we have our phones with an app on them where I can check how my investments are doing every minute if I wanted to. I compare checking your investments like on a daily basis to like getting on the scale, right? And weighing yourself daily. Now, some of you might do it, but personally, I just do it every now and then because I don't know if I always want to see that number on a daily basis. Um, so really, the issues, the point there of that seventh principle is that the issues we're having today really aren't that new. Stay focused on the big picture. Point number 2. Remain focused on your goals you have established and carefully evaluate any changes and decisions concerning all of your goals, short-term and long-term. It's hard to separate truth from noise. Things often look different from a long-term perspective. So stay focused on the big picture. If you're working with a financial advisor, usually we'll create your goals, right? And that's one of the first things we do is what are your financial goals? Most of us have the goal of retiring someday. Some of us have a goal of helping pay for our kids' college. Some of us have the goal of paying down our student loans. And so we have all these different financial goals. And the first thing we need to do is focus on those long-term goals and how we're going to reach those long-term goals. Point number 3, don't let your emotions drive your decisions. So if you haven't had a chance, go back and watch the previous Financial Sense presentation on the 6 barriers, I think it's to investment success. I might be getting the title a little bit wrong, but watch that one because that really talks about our psychology and what makes us make the decisions we make when it comes to investing and how a lot of those are emotionally based. Emotions can lead to irrational decision-making and impulsive decisions that often compromise the realization of stated goals. Before you react, make a list of your concerns, revisit your goals, and review your strategy. If your goals and your priorities have changed, or if you believe your strategy is no longer appropriate given the economic environment, contact your financial professional. When there is fear and uncertainty in the air, when there is scary news that makes you question what you should do, that's when you should talk to your financial professional. He or she can provide the perspective you need to understand the situation at hand and how it relates to your individual goals. So once we know a client's goals, we then create an investment strategy for them, right? And I understand their goals, I understand their risk tolerance, and so we'll talk about risk tolerance in a second. But then we create an investment strategy for them. And if their goals haven't changed or circumstances in their life haven't changed, a circumstance in life that could change is, oh, my kid doesn't plan on going to college anymore. Or I need to retire 2 years early because of health reasons. Then circumstances have changed and we probably need to make changes to your investment strategy. But otherwise, if your financial priorities haven't changed, then usually the financial strategy that you put in place is probably okay to stick with. But again, contact your financial professional just to be sure. Understand your risk tolerance. Risk is a part of investing. You can limit it, you can defend against it, but you can't eliminate it. The important thing is to understand how much risk you can tolerate and then build a long-term strategy that reflects that. So if you were invested on the stock market back in 2008, 2009, when we saw the market take a 55% drop, and you were that investor that was like, that's it, I don't want to lose another penny, Melissa, get me out of the market. Well, then we probably had you in too aggressive of investment strategy, right? We have to put you in an investment strategy that you can stick with during the ebbs and flows of the stock market, okay? Next point, stay invested. Investors stay the course, have historically been rewarded for their patience. When you look at the market performance over decades rather than just a year or two, what you will find is that while it may jump around in the short term, over the long term, it tends to grow. Be diversified. An appropriately diversified investment portfolio can help during periods of market volatility. Diversifying your investments across different types of asset classes. So asset classes would be like Real estate, international, large US companies, small US companies, fixed income, we call those asset classes, is a fundamental technique to manage investment risk. It is important because despite the best efforts of investment professionals, it's virtually impossible to guess in advance which asset class will have the best year in any given year. When I first entered the industry, I was working at my first job in finance was at Lake Michigan Credit Union as a teller. And they handed me this packet to invest for retirement, my 401k packet. And if you're in a nonprofit, it's called a 403b. And first of all, I was like, wait, you have to save for retirement? I thought Social Security took care of that. So I was just astounded that I didn't learn more about this in high school. But then the next thing I did is when I was looking, they were like, okay, you have to save money and then you have to determine how to invest it. I went and looked at the investments and I was like, oh, well, I'm just going to put 25% of my money in each of the 4 top performing investments. Not realizing that just because they were a top performer this year doesn't necessarily mean they're going to be a top performer the next year and the next year and the next year. In fact, if anything, those investments might be at a high. Maybe I should be buying into some investments that are at a low. So this is just all about being diversified because we don't know what asset classes are going to be top performers. Work closely with a trusted financial professional. A trusted financial professional works with you to identify your goals, needs, and aspirations to align your short and long-term goals with your risk tolerance. A financial professional also offers much needed perspective by helping to identify the consequences of impulsive and irrational investment decisions. Most importantly, your financial professional, backed by the resources of their firm, help you to achieve your goals by providing valuable insight and guidance on market issues, economic issues, and specific investment strategies. So the more things change, the more things stay the same. And with that, I'm going to go ahead and see if we have any follow-up questions from today. I do have a quick slide here that my compliance team will want to make sure that I show you real quick. So bear with me a second while I put that up while we're doing our Q&A here, okay? Not that one, let's switch that around. Can you see that slide?
Yes.
Okay, great. So we'll just leave that up there for a second, and then we'll move back to my contact information. So as part of today's presentation, and as part of you attending, if you're looking to bounce ideas or you have financial questions or concerns, and you're looking for a financial professional, please feel free to reach out. I'm happy to assist you however I can, or just maybe give you, I like to call it the next best step, right? What's the next best step for my financial goals? So
It looks like we had one
what
question.
resources do you recommend for moving beyond 7 figures? I'm assuming to achieve more higher than a 7-figure net worth is the question here. So we had a question come in. It said, what resources do you recommend for moving beyond 7 figures? That's a good question. I'll think about some additional resources or potentially some books that you could be reading to talk about that. A good one is Rich Dad Poor Dad. It's a great investment book. So I would maybe start out with that, but I'll after today's meeting, there will be a follow-up email with this presentation as well as with some links to some additional resources. And I'll make a note to add some additional resources. Do we have any more questions? I guess too, moving beyond 7 figures, while it's great to do that alone, that's where I think a financial professional can come into play significantly, because I'm sure you have a full-time job. I'm sure you're really good at what you do, but with the financial professional, that's what they're looking to do every day, all day, is wealth management, investment strategy, tax minimization strategies. So working with a financial professional is probably one of the best ways to go about doing that. A little selfless plug there, but any other questions? Well, with that, I'll stop sharing my screen.
Thank you. And I'll go ahead and take over sharing. Awesome. Well, it looks like we have 5 minutes extra. We'll give back to you all then. Thank you everyone for joining us this afternoon and throughout the month of February. Please join me in thanking Melissa for both her time and her expertise. throughout this entire series. We cannot thank you enough, Melissa, for your assistance in bringing applicable and financial programming to our alums. For everyone who attended today, please keep your eyes on your emails as we'll be sending a follow-up email to you later this week. Additionally, I do encourage you to visit the Financial Sense website as there you can I'm sorry, excuse me, as there you can view or review our sessions. And you can use the QR code on the screen here to find that website. It is gvsu.edu/alumni/FS as well. Lastly, please remember that as Kern Valley alumni, our commitment to you is as a Laker for a lifetime. We will always be alongside you and all of our alumni ready to help you reach your next goals. No matter what stage of your life or career, you can turn to us for a lifetime of support. With that in mind, you can find additional resources and future events by checking out our website, gvsu.edu/alumni. Thank you again.